So good morning, everyone. Thanks for joining. I'm talking about the 24 results here from a sunny Prague here in Czech Republic at CTP's headquarter. Good year, 24, a record year when it comes to profit, more than 1 billion euro of money we made last year, but also a record in terms of new deliveries and leasing. So we have built a lot of properties, we completed a lot of buildings, and we've signed many leases. And that is thanks to our clients, the unique model of the way we work, the park model, building full service business parks throughout the region. That pays off. A model which we have developed over the past decades and continuously improved to make sure that we have the right amount of amenities and services on site to support our clients in doing their business. So the client focus on core business and we provide the property as well as all amenities and services, which includes all of the energy, but also things like healthcare, public transportation, which we offer to our tenants in those parks. And the tenants, again, they work with their suppliers and create ecosystems whereby we help to support when it comes to education and other programs, including affordable housing for some business parks. So we focus and we support our clients in their core business. Has been good. And there's always local CTP teams on site to look after those clients and buildings, make sure buildings are in an excellent condition at all times. Happy tenants, that's what it is about. And that's why we've done more than 2/3 of all new business with existing clients. Long-term, loyal partners who we have been working with all those years. They're good for 2/3 of our business. Continue retention rate of around 90%. Signed 2.1 million square meter of leases last year, which is 7% up compared to 23. Especially the last quarter, we pushed it a little. We've done 14% more than we did in the Q4 of 2023. And there's more to come for 2025. The leases we are signing are higher than before. So we continue to see rental growth. We get more per square meter from a building than we collected for that same square meter the year before. So we continuously see rental growth, which is good. 25, more requirements going into 25. Markets are changing, which is good. Change opportunity. Nearshoring continues, definitely in Europe, for Europe, even more with our friend Trump getting into power. And it's in Europe for Europe, definitely, which has an impact on property demands as well as on infrastructure and energy. Maybe a wake-up call, and there is a lot of work to be done, but it's definitely opportunities for those in business here in Europe, especially that part where we are active in the Central European part, CEE, with most of the 10 markets where we operate, Czech Republic, Slovakia, Romania, and Hungary, where we are market leaders and continue to gain market share. Is the business smart location, has been and is now very important. We have affordable labor and infrastructure newly developed and a lot of support from local governments here in this part of the world, which is positive for our clients and helps them to grow their business. Also, we've been able to welcome new tenants. 20% of our leads in 24 were signed with Asian clients, companies from Asia who come to Europe to set up shop for their European business. So that continues. We see more demand coming. And we have extended our Asian team with both people on the ground in Asia, in China in particular, but also in Central Europe, where we have, for example, here in the Prague office, some new Chinese colleagues to make sure that we can support Chinese companies very much with the search for a location and help them set up their business, which includes the property, but much more than that. And we are here to support and make sure that these companies can get feet on the ground here in Europe and can be part of the industry and help build Europe. Obviously, geopolitical situation has certain impacts on the region as well. EU, similar to the US, is protecting their own market with regulations and import tariffs. There is continued strong demand from 3PLs and retailers. Fastest growing region in Europe is the Central European region. We've done multiple projects recently, including completion of the Tesco project, of course, last year in 24 in Budapest, Hungary, but also fulfillment centers for fashion retailers and others. So consumer goods, most of our parks are located close to larger cities. And of course, they benefit from consumer spending, which continues to grow because we see GDP growth in Central Europe double of what it is in average in Europe. So there is consumer spending and therefore you need warehouses, especially if there are no warehouses around. which, as we concluded, there remains an undersupply of A-class warehouse space in the region of Central Europe, especially when it comes to the setup as we do with the full-service business park, as I explained. GLA per capita in Central Europe remains low compared to Western Europe. And that means the square meters of warehouse space per capita, which is still a bit behind. Germany, I see and I feel we get a lot of support from German governments. And the last year we bought a fantastic site in Düsseldorf at the airport. We would not have done that without the pleasant talks and negotiations with the city of Düsseldorf. So the mayor, the city council, very supportive and interested in the project which we plan to do. We've acquired it. We have a team of people, around 100 people in Germany at the moment. We're currently working on zoning and design and permitting. So we hope that we can start the project soon. In the meantime, we see that we get some income from the existing buildings, which we bought. But that is going to be a unique, fantastic project. I'm very excited about being part of that project in Düsseldorf to build a CTP-style full-service business park in Düsseldorf to offer a next-level property for different companies, whether logistics, R&D, or light manufacturing. We want to make sure that we have something to offer for all, and that the park comes with all amenities and services you can imagine. So that's going to be our flagship project in Germany. In the meantime, we do a fantastic project in Mülheim. We bought that site also last year, as you may remember. It's 36 hectare. We're making fantastic progress on permitting, and I think that we can start to build next year in 2026. We are also talking to some tenants already, and we are in the middle of doing the demolition, so getting the site ready for construction. And there is much more going on in Germany. I think this year is going to be 250,000 square meter new build, and maybe next year even more. The situation where Germany is at the moment gives opportunity to buy at attractive prices. So I think this momentum is advantageous for us at this moment as we are new to the market. Quick update on our businesses. Operator, the team of people who look after the income producing part of the business. Talking about people, we are 900 people in the meantime. The operator is good, standing income producing portfolio. We were at around 93% end of last year. We've been able to grow the portfolio to 13.3 million square meter now. And that is good for 743 million euro of rental income per year. Rent comes from different companies. It's widely diversified, international, local, lots of different companies who pay on time and continue to grow. So there's more than 1,500 different blue chip tenants in a broad range of industries. That's for the operator. Move to the developer. The developer is the construction company. All the boys and girls who are busy building properties, which starts with doing the designs, the different feasibility studies, the yield and cost calculations, the financial engineering, but also the value engineering, They work closely with the people from the leasing team. That's the secret or the success, I think, is we work in micro teams, so not like 900 people sit in some office tower. No. We have them all around the different, let's say 10 countries, but in those 10 countries still, they are sitting in different projects to be very close to where the business is and where the clients are. So together, they prepare these projects for construction. And then they start to build those with a tenant or on speculative basis or when they talk to tenants. And anyway, developer, industry leading yield on cost, very profitable business, have done it for 25 years. We grow 10-15% per year, have a lot of in-house activities, including design centers. And as explained before, keep an eye on long-term quality and sustainability. Make sure that we build and continue to build very functional, above all, functional real estate, but obviously in a good way so that we create quality and secure long-term income from those buildings, which are generic designed. So they're not built for a certain purpose. They can be built for a variety of different activities for our clients going forward. That is, in short, 1.3 million square meter of completed properties last year at 10.1% yield on cost. Some of the highlights: Raben is one of our long-term, very valuable partners, logistics service provider, 3PL, but also we work with a lot of pleasure for DHL and DSV and Kuehne+Nagel, etc., but also fashion retailers, LPP, H&M, and other consumer goods business like, for example, Douglas, because I mean, everybody wants to smell nice, and it's great that Douglas continued to expand their presence in the region, that also here in Central Europe, we can smell nicely. And Tesco, also, of course, as I mentioned earlier, fantastic project for them in Budapest, which we did. This year looks to be larger, with 1.8 million square meters of new buildings under construction. 80%, 80 of all of those new buildings are under construction in existing business parks. When fully let, all of the space, we will add another 142 million euro of rental income on our way to hit 1 billion euro of rental income per year. And with yield on cost, we keep as a good tradition at around 10%, maybe a bit higher. And we expect to be leased at 80, maybe 90% upon completion of those projects. So far, maybe a short note on energy. Energy is going well. It's our third business line, if you like. It's very small compared to the other two, operator and developer. But energy is important to us, of course, to make sure we have the right amount of energy on site in our business parks. Energy is also about us continue to install rooftop solar plants, which we are at 130 megawatt end of last year. And is also appreciated by the tenants, of course, that have access to renewable energy right from the roof to the shop floor. Also, what we do in the project now to store energy. We will first see a pilot project going live in 25, and there's plans for doing more of those. It's very much a result of the ongoing talks and negotiations with our tenants to see how we can best support them when it comes to energy and the source of energy. And smart metering, for example, is another project which we continue to roll out that gives us a much better overview of what energy is being consumed where. And that, first of all, you can improve the amount of consumption. And with that alone, you can save a lot of energy and also cost and so on. So, and for the rest, yeah, I enjoy very much. I see many projects on a weekly basis. It's very exciting out there with all of these changes going on. And we want to make sure that we're going to be part of all of this change opportunity. And yeah, it's the year started very nicely, and we look forward to 2025 to become a very interesting year for all of us here at CTP and our shareholders. Thank you for joining. I'll hand over to Maarten, and I'm available later for any of your questions. Thank you so much.
Moving on to the financial highlights. The like-for-like rental growth came to 4% in 24, driven by indexation and strong rent reversion. Occupancy at year-end remained stable, 93%. And the reversionary potential stands at 14.5%. And we have been proven to successful in capturing this potential for the leases that came up for expiry. Our gross rental income increased by 16% year on year to 644.1 million euros. Net rental income went up by 90% year on year as we reduced the service charge leakage. Consequently, NRI to GRI ratio came to 97.4%. The annualized rental income increased to 743 million euros, illustrating the strong cash flow generation of our portfolio. And we confirm our target to reach an annualized rental income of 1 billion euros by 2027. The company-specific adjusted EPRA earnings per share increased by 9.9% year on year to 80 euro cents, in line with our guidance. Now moving on to the valuations. CTP's strategy is built upon long-term client relations, with around 2/3 of our developments taking place in existing business parks for existing clients. This de-risks our business model, as these are proven locations with existing demand. And it feeds as well into the valuations and the huge opportunity we have with our 26.4 million square meter land bank. Assuming a 50% build-up ratio, we can build over 30 million square meter of GLA on our land bank. And with a development profit of around 400 euro per square meter, this land bank will enable us to continue to generate organic double-digit NTA growth, also in the years to come. Looking at the valuation results, in 24, the revaluation amounted to 941.5 million euros. Standing assets, revaluation gain amounted to 499.9 million euros, mainly driven by the positive rental growth and slight yield compression in the second half of the year. The revaluation on our developments amounted to 380.4 million euros, driven by the leasing and construction progress on our pipeline. Our total gross asset value now stands at 16 billion euros, up 17.2% in 24. CTP's reversionary yield stands at a conservative 7.1%, and in the second half of the year, we saw 80 basis points yield compression, after the 80 basis points increase we saw in 22 and 23. We expect both further yield compression in 25 as well as positive EEV growth in the CE region. In most CE markets, inflation-adjusted real rents remain lower than 15 years ago, illustrating the affordability of the region for our tenants, as well as the midterm rental growth potential for us. We also saw transaction markets reopening in Europe, as there's more clarity around the funding cost. And especially with, on the private equity side, funds coming to their maturity, we expect to see more churn. We see this supporting our valuations, but as well offering opportunities for us. Our EPRA net tangible asset per share increased from €15.92 at year-end 23 to €18.08 at year-end 24, representing an increase of 13.6%. With this NTA growth and our dividend, we delivered a total accounting return of 70% to our shareholders in 24. And now I hand over to Richard.
We have a robust balance sheet and strong access to multiple pools of capital. In 2024, we raised €2.4 billion of debt and €300 million of equity. We also repaid €950 million of short-dated bonds, extending our debt maturity and allowing us to book a capital gain of €37.1 million. Our cash position stands at €855 million. When including our RCF, our liquidity position amounts to €2.2 billion, more than sufficient to meet our cash needs for the next 12 months. The average maturity of our debt stands at 5 years, with only €560 million of debt maturities this year. At the end of the year, CTP's average cost of debt came to 3.1%. This will continue to tick up going forward as we bring on new funding at today's higher interest rates to finance our development-led growth. However, we've seen our marginal cost of financing come down during 2024, and depending on the maturity, this is now between 3.5% and 4%. Thanks to our strong cash-generating portfolio, we have a healthy interest coverage ratio of 2.6 times, while our normalized net debt to EBITDA reduced further to 9.1 times. As shown during our Capital Markets Day last year, thanks to our market-leading development yield on cost of over 10%, each portfolio we invest in our pipeline increases our ICR and decreases our net debt to EBITDA. Our loan-to-value stands at 45.3%. Despite the large land bank acquisition we did in Düsseldorf in Q4 of last year, and it's down from 46% at the year end of 2023. Our loan-to-value will decrease further as we complete our development pipeline and the revaluation gains become fully booked. We are confident in the outlook for CTP. Our leasing remains strong, as shown during the year, and in addition to what we've already pre-let in our development pipeline, we also have 80,000 square meters pre-let for future projects where we didn't start construction yet. We see nearshoring speeding up in many industries, continuing to drive tenant demand. Our pipeline is highly profitable and tenant-led, and thanks to our industry-leading yield on cost of over 10%, we're able to deliver sustainable and profitable organic growth while maintaining our strong financial position. We expect to deliver 1.2 to 1.7 million square meters of developments this year, in line with our long-term growth forecast. We expect an EPS of 86 to 88 cents for 2025, representing 8 to 10% growth compared to 2024. This increase is driven by our strong underlying growth, partly offset by higher interest expense, as we repaid nearly €1 billion of lower coupon bonds ahead of their maturity in 2024. Thank you for your attention. We now welcome your questions.